You famously talk about the random walk, and it's important for people to understand that this is exhibited throughout life, this random walk pattern. There's a very famous chapter in your book, in A Random Walk, about basketball players, where you talk about the gambler's fallacy, where people have the illusion that because basketball players hit 3 shots in a row, they're going to hit the 4th shot, and it's not true. There is a random walk pattern exhibited even in people betting in basketball games on basketball players. That's an important insight in life in general, in addition to just investing in the stock market.
No, Bob, I think it absolutely is. That what memory plays tricks on you. You much more remember sequences that are the same from period to period. You much more remember that this 50% free throw shooter hit the last 5 in a row. And so you believe that there are streaks. But what happened was Danny Kahneman, who basically wrote the book on behavioral finance, he and his colleague Tversky did studies of the basketball players at Cornell University and the Philadelphia 76ers and found, it wasn't true. The players themselves believed that if they made the last 5 shots in a row, they were more likely to make the next one. But the 50% free throw shooter has a probability of 50% of making the next shot, no matter what the previous 5 shots were.
It's an important insight into behavioral economics and how people look for patterns. You have been very critical in the past, and we've talked a number of times about ESG, environmental, social, and governance funds. And even though they were very popular and have been popular for the last 3 or 4 years, you have not been a big fan of theirs. Can you explain what you don't like about them?
Well, look, I think it's wonderful to have yourself feel good by investing in companies that are going to be for the social good. What I worry about, though, is that the ESG funds don't actually do that. Supposedly, you're supposed to be able to do good things for society and do well financially. And I'm not sure you do either. And the reason is that I'm not sure what is a good company. For example, there's a utility, Xcel Energy in the Midwest, that's a, quote, bad company. Why are they bad? Because they burn coal. But Xcel is the only utility that has actually promised to be completely carbon-free by a date certain. They're making huge investments in solar and wind. So are they good because of the investments that they are making, or bad because they're still burning some coal? Natural gas companies, are they bad because they're carbon, or are they okay or even good because gas is the cleanest burning carbon? And do we feel great because we own Visa and Facebook, or Meta as it's called now? Do we feel that those are great companies because they generally don't pollute? Or are there things about the high interest rates and what's happening to some of our teenage children and grandchildren that we don't like about the whole social media business? So again, the problem is I don't know what's good and what's bad. And in fact, the raters, there are raters who give an ESG rating, they disagree completely. The correlation between 2 rating agencies is as low as 0.4. And just to put that in perspective, the correlation between Moody's and Standard & Poor's in doing debt ratings is 0.995. So we don't even know what's good and what's bad. Apple gets a perfect governance rating from one agency and a lousy one, worse one on another. So we don't know. And also, they don't outperform. The ESG funds are expensive, and they have underperformed broad-based index funds that I favor.